The hedge fund Three Arrows Capital has gone into liquidation, adding to the crisis gripping cryptocurrency. A court in the British Virgin Islands ordered the liquidation of the Singapore-based firm that was set up in 2012. Well, let's talk now to Jeffrey Tucker, who's president of the think tank, the Brownstone Institute. Welcome back to the programme, Jeffrey. Thanks for joining us. So what brought about the end of this fund? How did we get to this point?
Well, we got to this point because an enormous industry built up around a very high price of Bitcoin. Once it's a little bit deceptive, right? So once we went over 50K and the crypto sector ballooned up, and then we hit 60K, there was a lot of people out there that believed that the new floor would not really go below, say, 40. There seemed to be a kind of a predictability to the markets. Possibility was always there to drop down to 19K, but a whole industry had built up around the idea that this stuff is real and it's headed up. You make those kind of assumptions, you employ a lot of people, you get levered, you get a lot of backers. And when your main asset, your main product drops by 70%, you've got a serious problem. And it's a problem not just for the exchanges. You can see that Coinbase in the United States has laid off thousands of workers and withdrawn contracts for a lot of prospective employees, but in particular for hedge funds, because those deal not so much in the tokens themselves, but on the derivative markets that are building on top of the tokens and within them and building out the spaces. The hedge funds will always be the first to go in this kind of crash.
So what does this liquidation and the low price of Bitcoin say about the wider crypto market?
Well, it suggests that the scaling is going to be difficult in the future because a risk aversion always affects people after something as momentous as this. And by the way, historically, it's not particularly unusual. You know, when I recommended, not recommended, but when I was thrilled about Bitcoin at the $13, it went up to 30 and then 100 and fell back again to $13. It seemed kind of shocking that something like that would happen, but it's fairly typical in these markets. The problem is that when there's real employees and when people are leaving Goldman Sachs to go to work for Bitcoin for a Bitcoin exchange, things really change. So my guess is that we're going to have to go through several more years where there's obvious evidence that that the floor has risen on the bottom of the markets, if you know what I mean. So we don't know entirely what the right price of these tokens could be. That's part of the purpose of markets, is to discover that. But there will have to be a market conviction that it's got to be solidly for a very long time. I would think above 50K, and then with highs in the 6 digits before people get confident again about these kind of derivative companies that pile on top of the price of the token themselves.
So if confidence remains low, do you think this liquidation of Three Arrows will be the first of many? Are there concerns about the element of contagion here?
Well, no, the contagion would not be the right word, because that implies that every company is levered off every other company, as a typical banking system would be. And this market is definitely not typical, so I wouldn't use the word contagion. But yes, everybody's in trouble right now. A lot more companies that are not making the headlines are cost cutting. They're firing workers. They're scaling back. They're getting scared. So yeah, there's going to be a lot of shake-up in this industry for the coming, I would say, 4 to 6 months. So, and the next question, which you probably were about to ask, is when do I expect to turn around? And this is where it gets complicated, because I'm speaking for many people in the industry when I say that there was a perception dating back years that the crypto prices and markets were going to move independently of regular financials as a kind of a hedge, so that everything else would break, but Bitcoin and the other tokens would not break. In fact, there's a widespread belief that that there was an inverted relationship between, say, stock markets and crypto. So when they both started crawling up together, the prevailing theory was that the crypto price increase was real and a response to risk-averse regular financial institutions diversifying assets, and that the regular financials going up were just purely a response to the increase in liquidity that was provided as a function of COVID relief, if you know what I mean. None of that turned out to be true. And that's pretty scary, because what we saw is that the cryptos were magnets for this excess liquidity that was sloshing around over the last couple of years, and that all the price increases, as far as we can tell, were inspired by the loose money policies of the central banks all over the world. And that's an alarming discovery, because it changes people's perceptions about what this stuff is. You know, it's a kind of a Rorschach test where you look at these invisible assets out there. What are they? What do they do? And everybody imparts their own theories as to what they are. Well, the prevailing theory was that they're an alternative to conventional finance, only to find out that they're not an alternative at all, but tend to track up and down with regular financial markets. At least that's what we've seen over the last couple of years.
Jeffrey Tucker from the Brownstone Institute, thanks very much indeed for talking to us today.
My pleasure.